Trump's tariffs have clearly put like emergency brakes on an economy that some would say was already on a slowdown, and now we've got a tax bill that would like pressing the accelerator. So, do we have brakes and accelerator? Is this a good thing? Is this a bad thing? And how might it affect the economy? How will it affect you specifically as a business owner and investor? And I have with me today Matt Sekerke on the Wealthability Show. Matt, it is great to have you with us.
Thanks, Tom. It's great to be here.
So you've got a terrific resume. Just give us a few highlights of what you do and what you've been doing for the last few years.
Sure. I keep a foot in the academic world and the business world. On the academic side, I'm a fellow at Johns Hopkins University and at Durham University in the UK. I do research on financial markets, asset pricing, and how those things feed through to the larger economy. And business-wise, I'm a managing director at SEDA Experts, which is a consulting firm that focuses on the financial services industry. And I'm senior macro advisor at Hiddenite Capital Partners, which is a long-short equity hedge fund. We've been among the best performing hedge funds in the world for the last 5 or 6 quarters. And you know, I I hope I can deploy that expertise in unscrambling tax policy with you today.
I appreciate that. So Matt, I love first of all, love talking to other policy geeks like I am, and second of all, I love people who are crazy enough to do multiple things all at the same time. So, my our listeners are a lot of them are entrepreneurs, they're investors, they tend to do multiple things all at the same time. Speaking of doing multiple things at the same time. We have the master of multiple things at the same time, Donald Trump, out there wreaking havoc on the world economy for good or bad, which is, I think, is a matter of considerable debate. So he started with the tariffs, and just to be clear, I want your take on this. Tariffs are simply a tax. And the question is who they're a tax on, but they are a tax clearly on consumption, whether it's born in it appears, and I'd love your take on this. Appears that it's borne somewhat by the producer, but it's also borne by the consumer. There's a combination of people it's borne by, but it is a tax, and a tax by definition, especially a tax on consumption, is going to slow down. You slow down whatever you tax. Okay,
Mhm.
it's a weight, it's a drag on whatever you tax, and so when you add these tariffs, so let's ignore all of the disruption they cause, but let's just talk about them. Let's say that they were not like, these massive things. Let's go 6 months down the road. Things have leveled out. We have, say, a 10% flat tariff, or, we have tariffs that are more reasonable than people might think the original tariffs were. How do tariffs, yeah, historically, what's been tariffs' effect on the economy of the country that's putting the tariff, that's actually imposing the tariff?
All right. Um, yes, a lot to unpack there, but yes, tariffs are taxes. And I think that is, if there's anything that's clear in President Trump's intention with tariffs, it is that it spreads part of the tax base onto international trade and allows him to pull back the tax burden in other areas. And, there are some comparisons with the late 19th century where, that's a time before the income tax existed and most government operations were funded out of tariffs. And the justification for tariffs, has been purely for revenue in those early situations. Everybody has to come through the ports, go through the customs house. It's a channel that you actually can tax. But probably the best argument for it as a policy measure was made by Alexander Hamilton, back in the infancy of the nation. And it was to give producers within your borders the opportunity to learn enough about what they're doing before they can be competed out of existence by foreigners who are better at producing whatever that is. And today that argument comes back in the form of national security. That even if it is true that other people in the world produce certain food items more efficiently than we do, that they produce certain metals that are mined from the earth more efficiently than we do because of their resource endowments or whatever. We nevertheless should have that ability because in a war we need to be able to feed ourselves and we need to be able to produce certain things. Um, and that is really the way in for President Trump to take control of tax policy through his tariff policy. Because usually taxation is a power that's reserved to Congress,
Right.
except in the situation of national emergencies. And he's used this national emergency justification and national security justification to put tariffs on
Well,
what
and let's
almost
be
everything we do.
yeah,
And
let's
and
be
that
fair.
that makes it
He's
less
not the first
sustainable as a
president to do this. So
yeah.
he's just doing it in a bigger way, right? Biden kept the tariffs that Trump first imposed his first term. He kept the tariffs on China. Other presidents have certainly imposed tariffs before, and rarely does Congress interrupt tariffs. So tariffs. Would it be fair to say though that tariffs are a brake? They put the brakes on the economy. They put the brakes on consumption. I mean, that's not a question, is it?
Not at all. And it's not just consumption. We have to think of it from the production side too. There are so many processes in the American economy that rely to some extent on inputs that come from abroad. Whether it's labor, which we can contract at lower rates elsewhere, or other sorts of factors like natural resources that we just don't have in the United States. So it bites on both ends. It costs more to buy the things that we buy from the rest of the world. It costs more for us to make things where the processes are organized in the United States, but where we also depend on the rest of the world for inputs.
Yeah. So now, one of Trump's suggestion is that what he wants to do is bring manufacturing back to the US, and the tariffs is a way to do that because it makes foreign goods more expensive. And, let's face it. I mean, there are countries that impose huge tariffs on us that we don't impose tariffs back. I mean, that's a true statement. There are countries that have value added taxes, which I know most economists think they're fine. I disagree with that just because while yes, it applies to their people, their country as well as it applies to international, it is in fact a tax that when we don't have one, it's a one-way tax. So if we export to them, there's a tax. If they export to us, there's not because we don't have a value-added tax. So, but there is that. So we're putting those brakes on the economy. My and I'm going back to Ronald Reagan days because I was around in Ronald Reagan days. I know a little before your time, but I was around then. And what Reagan did, remember, is that he had this high interest rates and he had stagflation. He inherited an economy that was really slow. And so what he did is we had the high interest rates, which put brakes on, and then he had a massive tax bill in 1981 that put the accelerator on. Do you see that happening here? Even though I know most economists aren't a fan of tariffs, but do you see that mechanism between the braking of adding tariffs and the acceleration of reducing income taxes?
Well, I'd agree with you that the tariffs are putting on the brakes. It's killing confidence across the board, from senior management to investors to consumers. Like, confidence readings that we see from surveys are lower than they've been in decades. Um, Whether income taxes are pushing on the accelerator right now the way that they would have in Reagan's day is different. I think it's harder to say that the tax situation that we're starting from now is as stifling as the one
Mhm.
that we had in the early years of the Reagan administration. If you want to think of a Laffer curve kind of argument, I don't think we're as close to the peak or the declining side of that curve now as we might have been during Reagan's time. So, the ability of tax policy to further stimulate the economy um, is not as obvious. And I think you'd have to consider the way the distribution of tax benefits in the new bill comes out. They're really not as broadly based as the Reagan tax cuts were, and the idea that they're going to really stimulate economic activity across the board is difficult to sustain.
Well, surely, if the 2017 Act were allowed to expire, it would add additional brakes. I don't think there's any question there. People would have less money. They have less money. They spend less money. So, and people tend to spend everything they get, and except unless you're talking about the top 10%, but everybody else spends everything they get. So that would certainly put the brake. So I actually think the extension of the 2017 Act is probably the best part of this bill. And there are some things in there that are very heavy investment. One thing I want to talk to you about, Matt, is there are parts of this bill, this big, beautiful bill, it's actually titled that, interestingly enough, but there's parts of it that are very investment driven. So there's deduction, bonus depreciation. There's expensing of research and development costs. There's tax reduction actually for small business owners. So there are things that are very investment driven in that bill. And then there are these other things like not taxing tips, not taxing overtime, deductions for automobile interest, things like this that seem to be very consumption driven. I'd like your take on those things that are investment driven and from a policy standpoint. And in fact, potentially offsetting the tariffs versus those aspects that are consumption driven.
Right. Yeah, the investment focused features are, very continuous with the 2017 bill, the accelerated depreciation, like you mentioned. There's debate over whether these depreciation allowances favor investments of a longer term or a shorter term. Making it an expense just kind of removes investment from the calculus of taxation altogether. It's just the government giving up
Right.
that revenue. Um, this should stimulate investment. The research on the Tax Cuts and Jobs Act from 2017 doesn't show a major uptick in investment. The overall impact of the depreciation allowances and other benefits of that bill on the supply side were mostly given away in distributions to shareholders rather than increasing capital expenditure within business. So continuing that, yes, I mean directionally it does favor investment, but the bang for the buck of those measures is considerably muted. Um, and on the consumption side, like you said, I mean, expanding the standard deduction in the 2017 Act really
Mhm.
was what lowered the tax burden for most people. And where that's going to come back, we're going to extend that, which is
Well, we're
positive,
actually
but
making it permanent.
yeah, yeah.
This bill
Um,
makes it permanent.
but what changes the situation for people in low to moderate tax brackets is that they're going to lose a lot of government transfers. And so, you know, it whether it's worse than having their rates snap back to where it was without the larger standard deduction, I don't know. I mean, that's kind of a technical thing that'll have to be hammered out as the bill comes. But like I said, overall, the incremental amount of stimulus from this is not likely to be as profound as it was in 2017.
So, but let me ask you just in concept, okay? Um, if you give a tax benefit that is meaning that you have more money to those in the what I'm going to call the spending population, because the reality is top 1%, there's only so much money you can spend in a year. I mean, they don't, if they get a tax break, that's not going to increase their spending. That will more likely actually increase their investment than their spending because again, you can only spend so much money. Most people can only spend a limited amount of money every year. Nobody
I agree with
spends
that.
$20 million a year. Okay.
Right.
So the let's take these two specific that I think are very consumption oriented, so the no tax on tips and the no tax on overtime. How does that impact? Is that a short term, long term? Let's assume they're permanent, which they're not. They're 5 years, but even if they were long term, would they have a long term impact, or is it just like feeding a child a candy bar?
Um, well, I mean, it's kind of a game you play with the employers when you change the rules. So if there's less tax on tips, less tax on overtime, those things are cheaper for the employer. So does it make sense to hire 20 people, or does it make sense to hire 15 people and have them work a lot of overtime? Those are the kinds of decisions that will be
Interesting.
reconsidered in light of this. And likewise for tipped workers, there's this sub minimum wage where, the what you're required to pay workers is reduced if you can show that they're made up with it by tips. If we have more workers that are swept into that category, they're losing what used to be guaranteed earnings, and now they're put at risk as tips. Um, it's hard to say where it falls. That is as an employer, there is this incremental incentive to lean more towards tips. But we also know that Americans are kind of, at their limit with tips right now. I mean, I've been in an airport kiosk buying myself a bottle of water, and I check myself out and it asks me if I want to leave a tip, even if I haven't interacted with another person. So there are limits on how much we can compensate people with tips as well.
No, I get that. I guess my question, Matt, is um, if you give people more money, what's the impact on the economy when you give people who typically spend everything that they make? What's the impact on the economy? Is it a short-term impact? Is it a long-term impact? And how does that impact compared to incentivizing investment?
Yeah, I mean, of course it increases aggregate demand. The question is, how big is the base for which it increases aggregate demand? So if you have 100 people employed and all of a sudden they have more money in their pocket, that's great. But if the unintended consequences of that is to shift the number of employed people, down to 95 or 90, then the loss of economic activity
Mm,
might offset the additional
interesting.
spending you get from the people who are employed. And that's why I'm pointing to these employers' incentives that are created. You may have fewer people employed, but working longer hours to take advantage of the overtime incentives. You
So
may
you
have
think it could actually drive wages down, even though overtime typically is time and a half, right? I mean, typically you have to pay time and a half. So it's overtime for an employer, generally speaking, is more expensive than having the more employees, right? That generally more expensive because you've got 50% higher wages. Are you saying that because they're not taxed, it'll drive the wages down?
um, Yes, it can. And an employer's total costs also include recruitment and attrition of employees. And so sweating the assets you have can sometimes be a more effective means than going out and recruiting more people um, to keep your hours at regular wage rates rather than overtime rates.
So let's talk about um, so do you think that the um, incentive impact, the positive impact of this tax bill, because it adds a huge amount to the deficit, no matter how you slice it, it's going to add to the deficit. Unless you're just saying, well, but currently we're already adding to the deficit, and so the extension of the 2017 Act doesn't add to the deficit. We already have that. Unless you make that argument, which some of the Republicans are making, it definitely adds to the deficit. Um, does the positive impact to the economy offset, in your mind, the negative impact of the tariffs?
I would tend to think no. Um, the impact on the deficit is weighing on longer term interest rates. Excuse me. It's weighing on what we pay to finance our debt, and interest on the debt is already a major portion of the government budget. So as interest comes to encompass more of the budget, that's less demand stimulus that the government can give. relatively speaking. Um, you know, and yeah, I mean, if you can stimulate consumption, but if you don't have the production on the other side to meet it, then the result of that is usually just inflation. And as I pointed out, the impact of the tariffs is just as bad, if not worse, on the production side as it is on the consumption side.
Mm.
If you think, for example, to take automakers as an example, you may export and re-import certain automobile subassemblies multiple times before they end up as a finished vehicle for sale in the United States. So you can have tariffs biting on that process 4 or 5, 6 times before they reach the final consumer. Um, so no matter, you can have deductibility of auto loan interest kind of giving people a bigger budget to buy cars, but if the cars are twice as expensive as they were before, that doesn't leave anybody better off. So you might have more money in your pocket, but in effect a smaller budget because there's less to buy.
Interesting. So, one of President Trump's arguments that he's put forward is that this is a temporary disruption, that eventually it will force between the investment incentives. It looks like the Democrats aren't talking about increasing the corporate tax rate, which I think was a horrible discussion that they took up in 2018. But that seems to be permanent. The investment incentives, uh, and adding the tariffs. The whole idea being, well, we're going to force manufacturing back. So yes, we'll have a disruption for 2, 3, 4, 5 years. Conceptually, could it actually force manufacturing back so that rather than just doing the final assembly, we're actually doing all the manufacturing?
Um, I don't think it can because it's not close. If you want to think about making clothing in the United States, or something that's even impossible, like growing coffee in the United States, no economic incentive can make our climate right for growing coffee. And we benefit from being able to access the labor of the entire world, and the cost of labor that's embodied in the products that we buy from abroad would not be attractive to an American worker. Even after adjusting for how much more productive American workers are, these still don't produce better jobs. Um, we're better off sticking with the things that we do best, and we're a major exporter of services. Americans make incredibly good wages in service jobs, and to shift workers away from that so that they can work low wage manufacturing jobs that are less productive just doesn't seem like a good move for anybody.
So
Um,
let's talk about that for a second, because there's actually aspects in the tax bill that or proposed in the tax bill, who knows what it's going to end up with. We're going to end up with that would actually penalize service workers. Okay, so for example, the qualified business income deduction, what's now a 23% deduction under the bill, for the most part, doesn't apply to service workers. Some of the other tax benefits, they're talking about taking away the deduction for taxes from small, qualified, service industries. There are all sorts of there's a lot of pressure being in the service industry. I care about this. I think our lobbyists are really bad, but how is it here's the thing that we export. You're saying that, hey, we export this the best, and yet we're penalizing it. Do you see that? Do you see that as a real issue?
yeah, I do. I mean, historically, over the last 40 years, we've come to a point where service workers have done well, and people who were connected to manufacturing did not do as well. So the political demand for this is coming from the people who didn't do as well, and I understand that. Um, but there's also this culture war aspect of it that people who are working in services, they're the people with college educations, they're in blue states, they're in cities, they're not obviously part of Trump's coalition, and he could just leave them alone, but his inclination seems to be, well, let's kick them if we can. And clearly I'm not happy with it, and I'm somebody who believes in human capital. I've got too many degrees, for God's sake, but um, I don't see it. It is one of our strengths. It's one of our chief exports. We export a lot of college education to the world. We export medical care, management know-how across the board. We're in huge surplus in terms of services trade. I don't know why you would try to kneecap that.
So what about the idea that going back to your original point, that there are, we do have, I mean, we can't, my understanding is, and I'm not the expert in this, my understanding is we can't even build our own weapons, start to finish. Is that not truly a security issue? I mean, if we don't have our own steel, if we don't have our own rare earths, if we're not doing that, are we not putting ourselves at risk?
Um, I don't know. I mean, we seem to have very well-off gun manufacturers who, resist any kind of legislation that restricts their activities. So the lack of a robust industry on that end doesn't seem to wash. We also have the world's largest defense contractors, and we're exporting arms to the entire world. So I'm not sure what the lack is.
Well, I mean, clearly we import, say, for example, rare earths, which are used more and more in new technology, and we import like 90% of that from China. Okay, so anything that requires a rare earth, which as technology grows and develops, seems like it's going to be more, not less. That's a growth industry. Aren't we at risk if we can't produce that? We have it, we've just not mined it. Okay, so it's not that we don't have those resources, it's that we have not gone after those resources because it's been cheaper to get them from China. So do we not put ourselves in the hands of this is I'm basically parodying an argument that we hear a lot. Are we not putting ourselves at risk to people who we don't necessarily consider our friends by not having some of these strategic industries? I get clothing, I get that kind of stuff. But when you're talking about transportation, you're talking about defense, you're talking about some of these really essential industries for any country to really succeed and defend itself, don't we put ourselves at risk?
Yeah, well, I mean, I'd really love to be having a focused policy discussion about things like this that are really essential to security rather than an across the board tariff regime with every country in the world. And it's true, China is much better at recovering rare earths than we are. It's not because they're more common in China. They go and
Right.
they mine them in the rest of the world. But mining requires a lot of power. It requires a lot of water. And being able to do that in a regime like China's, where you can kind of create the regulations you want on demand, makes that possible. They also train a lot of metallurgists and materials scientists, and in the United States, we don't train people nearly as much as we need to be competitive there. But overall, you know, for rare earths are rare. But you don't really need large quantities of them to produce what we do. To add neodymium to a magnet, it's not like kilograms of it. It's a trace amount of it that really increases the strength of it. So I don't see a lot of processes that are running into limits where they can't get the rare earths they need at a reasonable price. And so it is a concern. It's worth thinking about, but it's not flashing red for me as a
Hmm.
as a major risk to getting on with what we're doing.
Okay, so now I want you to kind of change hats. Instead of being an economist that is thinking about what ifs, you're a business owner. You're a middle market small business owner in the US. What are things that you ought to be looking at? What are things that you ought to be doing in order to prepare for this? Clearly, this change is happening. I mean, clearly, Trump's not backing off. Yeah, he backs off here and there, but the reality is he's still moving forward with the tariffs. So, what does the small business owner do? What does the entrepreneur do practically in order to
Mhm.
deal with this?
Yeah. Well, what I see people doing now is they're trying to figure out kind of within the channels that they have, within the people that they deal with normally, what does their bottom line look like with tariffs in force? What does it look like at at the lower level of 10%, where we hope we end up. Um, can I survive in both of those states? Um, for many people, they're kind of willing to knuckle through the higher tariff version of that for the sake of their customers and for the hope that eventually it's going to go away. But if it doesn't go away, then you start to this starts to unfold in many dimensions. The suppliers that you have may not be the ones that make your business possible going forward, and you suddenly have to start requalifying everybody that you deal with. The material that you used to get from Thailand, maybe you're going to try to get it from Canada now, or you're going to try to get it from the Caribbean. I don't know. Um, but these are kind of the best worn grooves for every business there is. It's a lot of work to identify a partner, to develop a relationship, to have trust, to be paid on time, to get your orders filled on time. Undoing these relationships is really difficult, and I think a real major source of stress for every business owner right now.
Yeah, it seems to me that when times are tough is when the good businesses get better and the bad businesses go out of business. That
Mhm.
is forever. That has always been the case. Okay. It happened during COVID. It's happened after COVID. That's what happens. And so it seems to me like now to me, it's an opportunity. It's an opportunity to say, hey, I've been okay with these suppliers. Maybe I need to have additional suppliers. Maybe I need to, the benefit is we have AI now. It's much easier to find people than it was 5 years ago. Much easier to find suppliers, much easier to find alternative sources. So maybe it ought to just be, we need to be thinking smarter. We need to be working smarter, not harder, making sure that we're capturing the efficiencies that AI can give us in our business. So, we can actually reduce our headcount for sure, or we can increase the production of the headcount we have. I mean, whichever way you want to look at it. I like the idea of increasing the production of the headcount you have, but you don't have to add more headcount. You can do so much more. You can do so much better analysis. You can have better information. You can make better decisions. All of those things, it seems to me like we ought to be doing right now when we have this period of disruption and everybody is being disrupted. I mean, the best time to get smarter is when the whole world's being disrupted, because now you come out ahead no matter what happens, it seems to me.
Yeah, and I mean that's kind of why I resist saying categorically that, tariffs are going to lead to recession, or that we're definitely looking at some kind of outcome, because against that you have the ingenuity of every business owner working in your favor. And people find a way, and I have a lot of confidence in people to find the best way. Um, you know, Certainly, I think we could spend all that ingenuity in a better direction than trying to overcome a policy that doesn't have an obvious purpose or endpoint. But that's a great thing about the American system, is that you let people find these solutions in a distributed way.
That is what makes America great, frankly, is that we seem to be better at adapting and finding the solutions than any other block of people, and I love that about the American entrepreneur. That's why I love. I've, like you have. I know you live in another country. I've been in all over the world, and still, I would rather do business in the U.S. than any other country in the world, because it's just easier to do business here, even with things like the tariffs and the upset with the tax law, et cetera. And I would just encourage everybody, pay attention. Don't just say, "Hey, I'm going to wait, and it is what it is, and I'm just going to deal with it." Instead, now's the time to do something, whether it's understand how the tax law, this new tax law is going to affect you, and sitting down with your tax advisor, whether it's looking at new suppliers or looking at how technology can improve your business. I think now is the actual time, to take control of your business and really get a handle on it so you can be better coming out of this, whether there are 25% tariffs, 125% tariffs, or no tariffs at all. and no matter what happens with the tax law, because when that happens, you're always going to end up with way more money and pay way less tax. Thanks everyone for joining us on the Wealth Ability Show. Thank you, Matt Sekerke. Matt, where could we find more about you and your work?
I have a website at mattsekerke.com. My last name is spelled Sekerke, mattsekerke.com. That links to my recent book with Steve Hanke, which is called Making Money Work. It also links to my Substack, where you can read my writing from week to week, and to interviews I've done in the media on tariffs and other topics. So I hope you'll explore that. And thank you, Tom. I appreciate speaking with you today.
Thanks, Matt. Thanks, everyone, for joining us, and we'll see you next time on the Wealth Ability Show.
This podcast is a presentation of Rich Dad Media Network.